45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Good afternoon or good evening. Thank you all so much for taking the time to join us on our webinar. Really excited to cover this topic. I'm excited to be hosting this webinar in partnership with Reed Hazard from CMG Financial. This webinar has come at a really timely, in the real estate market where interest rates have been kind of the biggest headwind that we've faced for investors who are looking to purchase new properties and make deals work. It's really made it challenge for investors to make the numbers work, and we've been trying to figure out ways to overcome this obstacle, and we feel like we've created a really good system that we're going to show you tonight on how we've been able to get this exclusive financing rates from 4.75 to 5.25, right, and even in some cases below. So really excited to be able to go over how that's done, why that's important, and how that impacts some of the deals that we're looking at on a day-to-day basis. So just to quickly introduce myself, my name is Vince Tomich. I'm an advisor here at Marshall Reddick, and my primary role as an advisor is to learn as much as I can about each individual and to better understand your goals, to figure out what it is you're trying to accomplish through real estate, and to help you get there, right? So just to dive in a little bit more, I was born and raised here in Southern California. I have a background in residential lending, and I have now been with the company now for just over 5 years. I am a big fan of practicing what I preach. I'm a real estate owner myself. I've bought properties with Marshall Reddick. I've had Marshall Reddick manage those properties. I've borrowed money from Marshall Reddick. I've lent money with Marshall Reddick. I'm a huge fan of Marshall Reddick from a client standpoint and an employee. So I kind of can speak to both sides of that, and really happy to be able to help a lot of the folks who are interested in getting into real estate, and specifically those that are most of our investors come from Southern California, and to be able to reach out and get into markets like Texas, Tennessee, and Florida. So that's a little bit more about myself. For those of you that may be newer to Marshall Reddick, this is always a good time for us to go over who we are and what we do. So Marshall Reddick is a full service real estate brokerage, property manager, and private money lender. So to kind of break this down further, for real estate brokerage, we help people buy and sell property, whether it's a primary residence or an investment purchase. For those of you that purchased an investment property, 99% of the time you're going to need a property manager. So for our property management, we do everything from start to finish. So for marketing the property for rent, the showings, rent collection, rent disbursement, any kind of maintenance or repair requests we would handle. And then we also handle all the tax preparation at the end of the year, make sure we get you your 1099 and everything you're going to need to turn into your CPA. And then we are a private money lender. So we help, and unlike Reed, right, which at CMG, who does conventional loans, we do private loans. So let me give you some examples of people that borrow money from us. So we have the folks that do fix and flips. That's a great example of people who borrow money from us. There's those individuals who may have self-directed retirement accounts that may want to purchase property within that entity. You're going to need a non-recourse loan, so that would be another home for private lending. You also have individuals who have more than 10 financed properties. I see that all the time for those investors who are been in it for some time, and that's another good reason to borrow money from us. So those are examples that people borrow from us. Now on the flip side of that, we give our investors the opportunity to lend their capital, to be the bank. And again, we only do first lien position loans, so very secure in that sense. But instead of this is a really unique way of diversifying one's portfolio, right? A lot of folks have stocks, bonds, mutual funds, and real estate, but to also have a component where there is lending, right? And you can either have that component, whether it's in a one-to-one or direct lending capacity, meaning one borrower and one lender, and Marshall Reddick can fit, tie those two together. Or we have our investment fund. So our mortgage fund is a fund in which it's a pooled capital from multiple investors, and Marshall Reddick lends that capital to those borrowers that I just described. And the individuals who are in the fund get a quarterly distribution, and it's been a great way to get a much higher yield on your money than a savings account or even a money market account. Right now, our fund since inception has been yielding just around 8.5%, just north of 8.5%. So for any of these services that one may want to look into further, or just learn more about, I'd be happy to set up a conversation and go into more detail. So I just wanted to quickly explain, where in the United States Marshall Reddick has a presence. So you're going to see we're spread across 5 states across the country, and all of the cities you see outlined here is where Marshall Reddick has a physical footprint where we can help, whether it's brokerage, property management. Private lending is actually spread much further and across multiple states, but from the brokerage and property management standpoint, this is where we can assist you folks who may be interested in buying and exploring, or even those that already own property and may want to change and get join our management. This is a quick slide just with some of our teammates across the country. We have Texas up top, bottom left is Florida, our Newport office there in the middle, and then the Tennessee office there in the bottom right. So lots of folks that work with Marshall Reddick, and these are the folks that help from the property management, our agents, our software engineers, and everyone in between. So how do we choose these markets? How do we decide to pick these markets? Because I think you guys can all agree not every market across the country is a good market to invest in. So we feel as though this list of criteria indicates a strong investment market. So job growth, job markets, that's really important. You want to ensure that those individuals, that there's employment for those individuals that are in our markets. Low vacancy rates are important. Economic diversity, of course. Housing affordability. So that's a big one. For those of you that are in Southern California, like myself, the housing market is quite high, and it's hard to make numbers work at this price point. Interest rates aside, just the price point alone is a challenge. So we do seek out some of those markets that have a better price point to start. Landlord friendly, that's another one. We specifically focus on states that are going to be landlord friendly. With the majority of our investors who have been in this in this world for a while understand how significant that is. And strong education, you want to have good schools. And then last but not least is reliable property management. So that's a component that we can go into more detail, or we will be going into a little bit more detail. But nonetheless, buying a really quality property at a good purchase price is one component, but the real work is put in through the day-to-day management of that and how you operate that property, or just it's essentially a small business. So reliable property management is a crucial component. Okay, speaking of property management, I just wanted to quickly highlight, this is our basically our quick rate sheet, basically as to from our single family all the way to 30 units, the monthly management fee and some of our other fees involved. But essentially, what is the significance of property management? You know, and truthfully, the significance is to enforce the lease. Our role is to represent you, the owner, and enforce the lease, and essentially make sure that you're kept out of court, right? Like, there's a lot of things that go in between that, and to make sure we're caring for the property and maintenance is well taken care of, and everything is done according to code, right? There's lots of different state implementations that we have to keep an eye on, just to make sure we're following the proper rental laws. So it's a lot better for those of you that are interested in scaling up and really taking advantage of growing your real estate portfolio, to lean on a professional management company like ourselves. The software is also really critical that we use, and not to mention the boots on the ground. Our vendors and all of the people that are involved to help whenever there is an issue may arise. It's important to have a reliable team, and that's something that I encourage you guys to look into more if you're exploring this. We have lots of reviews online that you can look at and see what other people are saying as well. Okay. I'd now like to switch over and introduce Reed Hazard. So Reed has been an incredible partner for ours for many years. Reed is been a client and has been an incredible resource for myself personally, as well as all of our agents across the country. And he's the one who really spearheaded this idea of being able to leverage these lower rates, and it's all through his company. So I want to welcome Reed Hazard to the call. Reed, you're muted just in case. And yeah, we look forward to hearing from you.
Awesome. Thanks, Vince. Great to be here with you guys. I hope everyone's doing well, and thanks for being on the call to discuss the special financing. So yeah, thanks for the intro, Vince. Again, been doing this with Marshall Reddick for my whole career. So definitely just a big partner here, and love working with the team. A little bit about myself. Bought my first property when I was 19, and then I've done multiple deals since, and I own 3 properties in Texas that are managed by Marshall Reddick, and then I've got 4 properties here in Orange County. So some of the information I'm going to cover tonight is, I want to dig into just, first of all, what is a rate buy down, and what does that look like on a rate sheet? Current conventional guidelines. So what are the max credits that a seller can provide us towards doing a rate buy down or covering our closing costs? What is a forward commitment? So that's our special financing. How does that work? And then we're going to go over some new construction inventory, and then just the buyer paid closing costs, what that would look like for doing the special financing. So what is a rate buy down? Many of you have heard the term points, or paying a discount point, or paying a percentage to get a lower rate. If you went on Bank of America mortgage rates today, or Wells Fargo mortgage rates today, and if you look in the fine print, most of the quotes you'll see are always with around 25% or more down, and there are some form of points. So usually it'll say 0.75 discount points to get that rate. So usually discount points are used to lower the rate, but really in this type of market that we're in, banks know that you're probably going to refinance some of these loans, at least for normal market rate loans. People will be refinancing those at some time in the next couple of years. And so if that loan gets paid off quickly, then the bank doesn't really make anything on it. So there's just rates that are being advertised for the most points do have loan discount points on there. But I'm going to break down what a loan discount point is. We'll do an example on a $500,000 purchase price with 30% down. So that's going to give you a $350 loan amount. So paying 1 loan point is equal to paying 1% of your loan amount and loan fees to obtain the rate. So if it was a $350,000 loan amount, 1% would be $3,500. Now the max a seller can contribute towards buying your rate down on an investment property transaction, not on a primary residence, but on an investment property, the max all in that a seller, really that a lender, that the realtor, the max credit the seller or that the buyer can get on the transaction is capped at 2% of the sales price. So if that is a $500,000 price, I'm going to skip forward here just to this one slide real quick, and then I'm going to come back to that slide. If it's a $500,000 sales price, 2% would be $10,000. So you would know on this $500,000 property that you're buying as an investment that the max seller contribution, or again, any credits on the deal, will be 2% of the sales price, so $10,000. $10,000 in credit, if you were to use that all to buy down your interest rate today, you would be about a 6.5% interest rate. So this is the typical scenario without buying an interest rate down is about a 7.5 today, give or take, maybe 7.625. Okay, so going back now to this is a rate sheet just to give you guys an idea of what we look at on this end. On the far left-hand side here, you'll see the interest rate. You'll see the principal and interest payment based on the rate. Then you'll see the closing costs. This closing cost is a dollar amount of the loan points that you're paying. Discount points over here. So to obtain a 6.5 rate is 2.924 discount points, or 2.924% of your loan amount. That would equal about $10,234. So we would know that based on 30% down, if we put all the money towards buying down the rate, we can get a 6.5. And this is a great way to buy a property on like a resale property. If it's not like new construction and the seller has really limited funds they can do to credit the buyer, because for one, you have that 2% of sales price max. But in, a lot of cases, the seller, they might not have, enough equity after they pay agent fees too. So they might not even be able to give you 2%, but assuming that they can, this will get you a 6.5 rate. So that's a great strategy that we use if you're trying to buy, a resale property, or if the builder is only offering 2%, again, you could use that to buy down the rate. Some clients right now that believe rates will come down a lot over the next few years, if they get 2% of the sales price, they might decide to use that to cover their closing costs and maybe go with a 7.5% or 7.625 rate, and maybe even put more money down so they can get some break even, or even if they had a little negative cash flow, they're just okay with it because they're going to bank on refinancing. And we have a program through my company called Rate Rebound. And we cover your lender fees and your appraisal, and we cover $1,000 of your title and escrow fees to do a refinance at any time in the next 5 years after you close on your deal. So we have some great programs put together if the 2% is what we have to work with, or if you get no credit at all, but you're getting a great price. Again, you could take a higher rate and then refi it in the future. But to get the cash flow where we need it to be, the 6.5 is about the best that you can do before you're coming out of pocket. If you were to come out of pocket with an additional couple points, so you use that 10,000 to get your 6.5, and maybe you want to pay a couple points on top of that, you can get down to a 5.99. But as you can see here, when you come down to these really low note rates, these are tied to coupons that have very low trading volume, meaning there's very low demand for anybody getting those types of rates right now. So the cost to obtain them goes up dramatically. Look at a 5.25, 8.338 discount points to obtain that rate. So how do we get down to these special interest rates that we're talking about tonight? So back to this slide. Sometimes the seller is a builder, and when they're willing to give more than 2%, how do we utilize that concession? When there's a transaction between us, the bank, CMG, and you, the client, that transaction only allows the seller to credit 2%. So how do we get around that? So we develop a forward commitment, okay? And the forward commitment, for example, this is a separate transaction from the transaction between the consumer and the bank. So in a forward commitment, we can have the builder commit to giving us a certain amount of loan volume in a certain amount of time. So they could say, hey, Reed, we're going to deliver $10 million of loans And they're going to be all different loans, right? Depending on the down payment. Some buyers put less down, some put more down, some put 5% down as a primary, some put 25% down on these properties, or 30% or 40. So they're going to be different loan amount sizes. But as those loans come into us, we're going to get a combined loan amount of $10 million of loans to you guys in the next, call it 12 months or 6 months. And for doing that, they can pay our company to lock in a rate sheet. And that is a separate transaction than the transaction I then do between my bank and the consumer. So they can decide to buy a rate sheet from us and go, okay, that 5.25% interest rate is going to cost 7 loan discount points to obtain. We're going to pay for 5 million or 10 million of that loan. Now that is now the rate that I come to the consumer with, and that you are allowed, basically I'm allowed to sell to you. Now, what's going to dictate the amount of cost that the buyer is going to pay? Because there's still some points cost the buyer needs to pay on a forward commitment for the loan that they're doing. That's going to be dictated by the type of loan that they're doing. If it's an investment property or a primary residence, the down payment's going to make a difference, and the credit scores are going to make a difference. If it's a 2 to 4 unit property, then it's going to make a difference. So there are still some loan discount points that the buyer will pay, but it's very palatable. I mean, to pay, for example, 2 loan discount points to get, a 5.25% interest rate or a 4.75 interest rate, that's just phenomenal, because to get to a 4.75 today is about 11 points. To get to a 5.25 with perfect credit and 30% down, on a single family home is about 8.5 points. And to do it on a duplex is over 9 points. So they're paying, again, to lock in a par interest rate, meaning that there's no points, and it's basically a raw rate, which we then can take to the consumer in a separate transaction. So that's how we're doing these types of special interest rates right now. So we're going to segue a little bit into why we like new construction. Vince is going to talk on this in a second, and I'll just say that after owning real estate for a really long time, if you buy in great locations, the properties go up over time, your loan balance goes down, but you're going to realize more maintenance over time. You're also going to realize more maintenance when you go to sell the property in 15 or 20 years. And that will definitely eat into your profit. Again, I love resale properties, but new construction, the price of new construction is not a whole lot more than resale to begin with. And when you look at the amount of maintenance costs, how it cuts down on that over time, that to me is very, very attractive. It's also a lot of new construction going on in the path of growth. So definitely a lot of potential for new appreciation in some of these areas where they're growing a lot. Obviously more variety. And then the builders, builders are not in the business of holding on to these properties. They want to sell them, and they need to sell them quickly because they're paying financing on their construction costs. And so that's the purpose of them selling. So they generally go into this with greater flexibility on being able to give incentives. They don't want to drop their prices because they're continuing to phase up. And the economy, the jobs market's been red hot for a few years, and it's starting to cool down a bit, but the economy is very strong. And so, the builders, if they sit long enough, that they just start putting tenants in their properties and then sell them with tenants in place. And they do tend to sell them over time, but they'll sell them a lot faster if they give great incentives. And we notice when we attach special financing to properties that are already in really good locations that are built well, they just go a lot faster. So that's why a builder may be more incentivized to do this type of special financing at, $25,000 or $30,000 a unit, because again, they're going to sell it that much faster. They're going to get clients that want to continue to buy through Marshall Reddick, so they're going to get more deals over time, and it just feeds their business. So that's kind of my take on why new construction, and then Vince is gonna interject on that.
Yeah, Reed, well said. I'll say that when I'm working with clients, and right now, there's a lot of clients that have the impression as to they can get a really good deal, right? Because of the market may be a little softer, it's a little slower, and even more so in specific areas. But when you think about it as at a macro level, like as a seller, who has the biggest pain point? And it's those with the most inventory. And who has the most inventory? those are oftentimes builders, right? But like Reed was saying, builders are carrying like heavy, high interest construction loans, and oftentimes they need to sell properties in order to start working on the next property per banking guidelines. So they are very much incentivized to sell property, and as Reed mentioned, reluctant to lower price because of the way that the comps will be labeled, and that essentially they could be lowering the comps for the rest of their development. So very weary on lowering sales price, but what they are willing to do is they're willing to do this forward commitment. And as Reed described earlier, it's basically the builder saying, hey, CMG, anybody who wants to buy my product, I'm going to pay enough money for them to get 5.25 or 5% or 4.75, whatever they feel like would help that property sell. And we as agents advise on that, and we do that by running the numbers. So it's I look at this as a win-win, because at the end of the day, the builder is able to offer some kind of solution by bringing the rate down, but it's also great for buyers because they're buying new construction. As you see here, it's going to be very little maintenance, or to no maintenance, especially in the beginning. There's a great demand for tenants who are they want newer, nicer, better. So new construction is a great fit. And of course, there's all kinds of variety, right? We're going to show you guys from a single family home all the way to a 4-unit. So new construction is definitely the best fit when implementing creative ways for financing and when trying to target quote unquote deals, because when the rates start to come back down, what we're going to see, like we saw a few years ago, there will be no incentives and there will be lots more buyers, and the builders are the first to do away with those. So my recommendation is, while these kind of deals are on the table now, definitely worth taking a very close look at.
Definitely. Really, really great points. I also get this question, well, Reed, are they just inflating the price and then that's how they're paying for the special financing? And you guys know, because this is a conventional mortgage, we are ordering the appraisal through a third-party management company. That management company is selecting the appraiser and going out there. No one's talking to them prior to completion of the report and trying to influence the value. And when these appraisals come back, what's so funny is I've been seeing them come back even high. I've noticed on our Bill Mays deals we have in Tennessee that the appraisals are coming back in a lot of cases 10,000 high. And on a conventional deal, you could be getting a deal where, man, you have some built-in equity and you know it. And the appraiser on a conventional deal, even if the comps look higher, they just bring it back at the sales price because they're not trying to bring it in high. They're trying to make sure that that value matches what you're paying for it. And how can I justify that? But when you see a conventional appraiser even like okay to bring in a deal high, that's a good sign that they're, again, it doesn't have to come in high for it to be at value. If it's at value, there's a system that the underwriters on our end run these loans through to determine if the score is safe. And the score has been coming back very safe on these. And we're actually noticing, like I said, on a lot of these, the appraisals are even coming in high. And so again, it's a great question to ponder and to ask, like, are they just inflating the price? And again, the answer is no. And I've seen it firsthand. And in a lot of cases, we're even coming back high. So to Vince's point, this is a deal right now while we're in this kind of lull where rates are still at, 7% on a primary home, and the Fed's trying to still figure things out. We're still in in an election year, and there's a lot of uncertainty with multiple wars going on and lots of uncertainty, but still a strong economic market where, again, I think just like Vince said, as the market finds its way over the next 12 months, the builder, the first thing that they'll do is maybe they don't drop the incentives entirely, but they're definitely not going to be paying for the cost to do this type of financing. They just won't need to. So definitely a good time, I think, to get in, and I definitely agree with you. A little bit about why CMG. So we're the largest privately held mortgage bank in the nation. We don't do depository loans or credit cards or anything like that. But as far as mortgages, we service our loans. You make payments to us after closing. We have the lowest interest rates out there. And, we really do have the ability to innovate. Our partnership with Marshall Reddick has really helped, me personally over the years to grow out an amazing system. And CMG and my company and Marshall Reddick have a lot of trust built. So the system is just great. Everything's in-house, so we're the one that actually funds the loan. We are the bank. We're not brokering or anything like that. And then also, again, the rate rebound program. I think it's just a great program. Even on this type of financing that we're doing, you'd still get this. I don't think that rates will come down to a level in the next 5 years that it makes sense to refinance the type of loans that we're talking about tonight. I think those are loans that you build it into your spreadsheet to keep that loan for 10 years or 15 years because the rate is just so good. But again, I love the rate rebound program, and we're offering that for any time in the next 5 years. And then we are licensed in all 50 states, so we can help out anywhere. Here's just a little bit more info on the rate rebound program. And I have a flyer and I have a coupon on this that I send every client that gets pre-approved, so you guys will have this for your records. Getting pre-approved, so if we wanted to get pre-approved to do the special financing or to buy a resale property or to buy a primary residence, we have you do your loan application through reedhazard.com. My production managers, Brian and Mike, will reach out to you after the application comes in. We'll collect any of your documents. We'll review the application for accuracy, and then we run a actual loan approval through underwriting so that we have an actual solid pre-approval that you can go out there and you could write an offer to close locally. For example, I just did a 15-day escrow, so we're doing really aggressive offers locally when we need to. Out of state, when you're buying an investment property, we always try to get you a 30-day escrow just so you have more time. But in a lot of cases, you might need to close faster than that. You might want to close faster. The builder might be given a special deal in some cases on a particular lot, and they need it to close though within 21 days, so they're not stuck paying an extra month of interest. So in some cases, we'll need to even close faster. You might want to, but getting pre-approved sets you up for that. After we get you guys pre-approved, we can do a consultation call. We can go over all the numbers, and then I have a slide here a little bit later on what the costs look like when you do the special financing. So we'll cover that after the property slide. And this is what a pre-approval letter looks like. Also, if you're like Reed, I want to put $250,000 into real estate. How much property can I buy? Well, with 25% down, that's about $1 million worth of property. 30% down, that's about $800,000 worth of property. So depending on how much capital that you want to use, part of getting pre-approved is also building a game plan. Maybe you're looking to do a 1031 exchange and sell some of your properties that have gone up a lot during COVID, or might be in markets too that you really weren't moving a lot in value for many years after the Great Recession, and now they've really come back, or they've doubled in value or tripled, and now you kind of want to get out of those properties before they get too old and 1031 exchange those into new construction, but you don't want to take current rates. What a great scenario to sell those, lock in new construction with 2018 interest rates, and then do a 1031 exchange and not have any trouble identifying within that 45-day identification period, because we're already vetting the properties now through the pre-approval, and you're talking with Vince and talking with our agents and picking out those properties. I mean, this is a great opportunity to be able to do that and then not have to take 2024 interest rates. So we're going to cover the featured properties. So I'll give it back to Vince.
Yeah, thanks, Reed. All right, guys. So we're going to break down, from a single family all the way to a 4-unit, and they're going to be in various markets. This market is our Clarksville, Tennessee market. These are brand new construction, single family homes. And again, every property that we're going to show you has some type of forward commitment there, meaning that the builder has agreed to buy down the interest rate for their, potential buyers. And that's worked out between the builder and Reed. So in addition to that, as Reed mentioned, you do have the ability, in the event that one would like to buy down the rate further or do anything like that, you can add on to this if you would like. But this is something that the builder has promoted. So we're going ahead and showing some of these properties. I'm going to take a little more time on this one just to walk you through some of the metrics, and then we'll move a little quicker through some of the other examples. But you'll see on the left-hand side, it's kind of some quick data points. Built in 2023, 1595 square feet, 3-bed, 2.5 bath, and this is in our Clarksville market. These are being built, of course. This one is an example of one that looks like has sold, but there's these exact models, currently being built in 2024, just so you folks know. So the list price here is $309,900 in the top right corner. And then we assume a 30% down payment. Now, for single family homes, you don't have to put quite as much down. There is an option for putting about 25% down to make these kind of deals with the forward commitment work. As you come down in down payment, meaning lower down payments, the loan amount gets higher, the cost for points and some of that goes up, right? Because that loan amount is increasing. So something to keep in mind, you're not forced to go with the 30 if it made sense to come out with a little bit less cash, but just something to know. Most of our default figures are gonna assume that 30% down number. And then we have our closing costs here, which come with the standard closing costs, as well as some of the points that are involved with the financing, which Reed will go into on our next couple slides. But it starts here with the gross rent at $1,900. You'll see the mortgage payment is the principal and interest, and you'll see that 675 was crossed out, and we have that 5.25 there. We have a line item for our taxes, our insurance, our management fee. Some of the communities have an HOA, some don't. This particular one does have an HOA, and that monthly fee is $37. So then you'll see your fixed monthly expenses are at $1,667. So if you take your $1,900 rent over your fixed expenses, you get a monthly income of $232.78. So that is covering all fixed expenses. Now, that's something that's really important because this is what most of the time the numbers are going to look like. These are your fixed expenses. As everybody knows, these are going to arrive every month no matter what. So it's really good to know that the property can take care of itself from a fixed standpoint from day one. Now, for those of you that are new to real estate, or for those of you that have owned real estate for a while, maintenance and vacancy are a component of owning investment property. Now, with that being said, the maintenance on new construction is oftentimes very, very low or insignificant, especially for the first few years. So I think, even take a pretty conservative approach to assume 5% maintenance on this build. So that assumes about $95 a month. And then we have 8% vacancy. So 8%, given that this is an A-class property, we have different property classes that would designate the amount of vacancy that we're going to estimate. So 8% translates to about 30 days out of the year. Now, I also think that this is a bit conservative. We've definitely seen properties that are renting much sooner, but to be on the safe side, it's good to assume this value here for about 8% vacancy. And then we also take a leasing fee. So anytime that we have to place a tenant in a property, we would do the fee is 50% of the first month's rent. Right? So we take that number and we divide that over 18 months, because we assume that you're not going to have a renewal every year, but maybe every 2 years is a little long. So we kind of split the difference. It said a year and a half. And this, again, that's a more conservative number. Some tenants stay for 4, 5, 6 years, and you don't pay a new leasing fee. You do pay a lease renewal fee, which is only 15% of the first month's rent. But we do factor in leasing fees every 18 months as a way to be more conservative. Now, when you back out all of those variable expenses, year one, you will have a slight negative. And that's going to be common. That's going to be very common in investment purchases on day one. Now, something to also consider, just as I actually finish here, you'll see that assuming that you hold the property for 15 years, you'll see a profit of $192,000, and the annual return on investment, assuming a 15-year hold, will be just over 12%. Now, one thing that we don't factor in our 15-year projections is rental increases. So for those of you that are property owners, investment property owners, or for those of you that are even tenants, I'm sure you guys have, tenants have faced rental increases, and for you property owners, you understand that you do raise rents, whether it's annually, every 2 years, whatever it may be. We we at Marshall Reddick, and part of the management team's job is to monitor the market and see where rental rates are going, and not to let them get too far away from us, right? We want to increase rents based on where the market is. We also respect the quality of really good tenants, so maybe there is a slightly below, just if you have a great tenant that you want to keep, and that's up to your discretion. But basically the moral of this explanation is to let you know that we are not factoring in those increases. So this would be assuming that rent stayed the exact same for the next 15 years, which is very unlikely. So again, this is another point to show, taking a conservative approach to some of these figures. But nonetheless, we wanted to show you how you can definitely, make sure you're covering all fixed expenses day one, which is fantastic. Okay. So now that you've kind of seen how I've worked through one of those, here's another. This is a duplex in Buda. That's in South Austin. This is another A-class property. This one is built in 2024. These are available. These were actually the builder for this community was actually just released these to us. There was a potential where where there was going to be a buyer for the whole community, and we were really fortunate to be able to actually sell these individually to our Marshall Reddick clients. So we're really happy because these are something that we've really looking forward to having some kind of South Austin multifamily. That's just not very common. So to have this has been a really great opportunity for us and for our clients that are looking in that South Austin area. So these properties, 3,600 square feet, and the current list price is $649,500. Again, these are about 1,800 square foot a side, 4-bedroom, 3-bath. So these are huge. So what you'll see here is assuming a 30% down payment. Now keep in mind, the minimum down payment for multifamily is 25%, right? So putting that 30 down really does help the numbers, and you can't go any lower than 25. So 30 is pretty much how we would get these properties to work with the forward commitment financing. You'll also see we have our closing costs there for a capital investment of just under 214,000. Gross rent 4,500. That's assuming for both units. So just about $2,250 aside. You're going to have your principal and interest for the mortgage, your taxes, your insurance. We have our management fee. This community also has an HOA. So you'll have your fixed monthly expenses at just over $4,000, which leaves you a monthly income of $458.12. Okay. And then as you see, as you back out your maintenance and vacancy, again, a slight negative in year one. Now, something to see here, there's quite a bit of this projected profit, and you'll see the last property had a return on investment of about 12%. This property is closer to 21%. The real, the big differentiator in these metrics is going to be appreciation. So we have our calculators that forecast appreciation, and that's based on the average from the National Association of Realtors over the last 30 years. So if you look on our website, you'll see an appreciation model that shows the appreciation all the way back year over year. So we take we find out the average, and then we even take a lower estimate when we factor in these projections. So again, kind of speaking to our conservative approach on this, this would be an annual average of about 21% return on your money if you were to keep this property for 15 years. And again, assuming no rental increases. So just a really quick story for myself. I own a property, a duplex in Texas, and upon acquisition, the property broke even. Just after fixed expenses, it was basically zero. And the one nice thing about multifamily is you get the benefits of economies of scale. So I was able to bump rents. They were a bit behind market, about 150 aside. So really quickly going from 0 to plus 300, I know I can't, now retire from that, but it just goes to show you that these numbers can change relatively quickly, especially when you have multiple doors. So again, I keep reiterating, this is just day one. This is a long haul. This is a long-term investment, and you're going to be able to adjust and tweak it along the way to really get it to work at a great level. But it's all about locking in good opportunities when you can, whether it's price or rate or whatever that may be, so that you can improve upon it as time goes on, as you hold real estate for the long term. Okay, now here's an example in Southwest Florida rather. This is another new construction development. This particular property is an example of one that was built in 2023, but there are plenty that are being built this year in 2024. So these are 3-bed, 2-bath each side, 2360 square feet total. So this is a purchase price of $550. Again, assuming a down payment of 30%, and you have your closing costs factored in there. These properties rent for about $2,000 a door, so $4,000 total. You'll see our principal and interest there, our taxes, our insurance, our management fee. This property does not have an HOA, does not have utilities, and we do factor in landscaping in this particular property. It's case by case when it comes to the landscaping, so that's something that we just felt like was worth factoring in. But that's obviously negotiable as well. So this property does have quite a bit more cash flow. So with a $4,000 gross monthly rent and your fixed expenses just over $3,000, you're left with about $873 in monthly income. So this is really great because you're able to, really be able to have some cash flow on a new build, which is rare. So with our even backing out our maintenance and our vacancy and our leasing fee, you'll still see that you have a positive, month over month, assuming for those variable expenses. So for those of you that are more conservative, that want to make sure that you have a higher cash flow, this is a great example of something to take advantage of. And lots of folks moving to Southwest Florida. And you'll see here the profit over 15 years is just over 500,000, and the annual return on investment based on a 15-year hold is just over 18%. Okay. Finally, we also have, I wanted to show you guys another example. I know I was going to say I wanted to show you some variances in our product. So we go from a single family, a couple duplexes, and now we have a 4-unit here. So this is a 4-unit in San Antonio, Texas. Also built this year. So 12 bath total, 12 bed, 10 bath. These are great for those looking for multiple doors, right? So the list price here is just over $1 million, $1,050,000, 30% down. And the gross rents on this is just over $6,000. And the builder on this particular model has even taken the rates down even further. So the builder for this particular build is buying the interest rate down to 4.25. So that's, as Reed showed you on that rate sheet, that's well below even what a primary investor can get paying a bunch of points. This is investment property. So you have to also remember, there is a difference between the rates from a primary buyer and an investment buyer. So to think that we're getting this as a investment purchase, investment property rates are higher, average of 1% or even greater. So to have that ability to get the rates this low on an investment purchase is pretty unique. So after factoring in taxes and insurance, and we have our management fee here, you are going to have a monthly income of just over 500 at 533.55. And if you back out your variable expenses, you'll have a negative there in year one. Again, something that could easily be adjusted, especially with this many doors, right? Small increase to be able to move that up. It's not going to be very long. So Something to keep in mind here as another option for those of you that are looking for larger purchase prices. I will tell you, for those individuals that are seeking out or in doing 1031 exchanges, the new construction model is fantastic because it really alleviates a lot of the stress of finding replacement property. We have a fair amount of inventory in most of these communities, which allow you to comfortably identify and close on properties. And you know, we're very familiar with the process and very plugged in with the builder to understand closing timeframes, because the second element to a 1031 exchange is being able to close within 180 days, and we'll make sure to seek out properties that fit and make sure that you're not up against any trouble there. So you'll see the profit here, just over 950, almost $1 million, assuming a 15-year hold, and that return on investment 18.46%. So I'm going to give it back to Reed for a quick couple minutes here, just to talk about some of the points and the closing costs that are associated, and we'll go from there.
Awesome. Thanks, Vince. Great job. So what are the points that a buyer would pay in general? So if it's a primary residence, and we have a lot of buyers that are starting to buy these as primaries. The reason why is back in November of last year, they changed the guideline for 2 to 4 unit properties. When you're buying it as a primary home, they reduced the down payment. And the requirement used to be you had to put 15% down for a duplex when you bought as a primary residence if it was a conventional mortgage. And they reduced that to 5%. It used to require 20% down for 3 unit and 20% down for 4 unit. Even if you're buying it as a primary, 20% down. They reduced that down to 5%. So you actually could buy a 4 unit property now with only 5% down and get special financing like this. We just had somebody contract on a Harry Hosman four-plex, which is the one that you were just looking at, with a minimum down payment of 10%. They decided to do 10 instead of 5 at a 4.25% rate. They have a 780 plus credit score, and they're paying about 1.125 loan discount points. So this is phenomenal. You know, you guys, I think that adds more demand also into the communities. So you now, when rates come down over time, just know when that primary home buyer that can't enter the market right now, that has a good job, but the payments are just, they're not able to qualify. Their debt to income ratios are too high. But maybe if mortgage rates are 5.75, now they can enter the market. There's going to be that many more buyers now in these really good locations that have 2 to 4 unit property. There's that many more primary home buyers that are doing house hacking. And that means when you go to resell these properties in the future, you've also now have more demand in the market, because the most highly used mortgage in the nation, a conventional mortgage, you now can be a first-time buyer. You don't have to even be a first-time buyer, but you could just be a first-time buyer that wants some supplemental income from the other units or other unit. If you're buying a duplex, and you can live in one side, rent out the other, and put as little as 5% down. Even without the special financing, we have people getting 2% of sales price credit and doing a buy down on a primary residence to 6.25 and living in one side. So I'm noticing a lot more demand on the multi-unit from that side. And the way that these properties are built, if you look on the Marshall Reddick website and you look at the different builder partners and really the inventory in general, you notice that there's a theme. They generally have 3 bedrooms and 2 bath on each side, or each unit has 3 bedrooms and 2 bath. Some have 4 bedrooms and 3 bath, but never are you going to see usually like 1 bedroom, 1 baths on each side and a 2-1, some random unit counts. You'll also see they have a 2-car attached garage. On the duplex, it's always a 2-car attached garage for each side. Each unit, no matter what kind of property, is going to have their own attached garage, and they have a separated backyard on the duplexes. So what you see there is you see a theme that these properties are built for long-term tenants. These properties are built for buyers that want to buy a primary residence and want supplemental rental income, and that they can buy a property that's built like a single family on each side. They can live on one side, have a 2-car attached garage, separated backyard, 3 bedrooms and 2 bath, and they could live in that property and have a family. They could have a baby in that property and not have to move out of it. So because of that, I think about resale value a lot. Owning rental properties now for a long time, I'm looking at how do I want to trade these properties around in the future. I have a lot of equity now in them. Some of them are getting older. And so when you look at buying this type of multi-unit, again, the bed and bath count, the layouts, the attached garage, these are all things that will help you to have better tenant quality that stays longer in the properties, and also a higher resale value when you go to sell these in the future, if that's going to be your plan to 1031 them up, or maybe you want to pay them off and have 10 doors paid off. I mean, and because you're buying new construction, they're going to last a really long time. But again, on that resale price, I think that that's really going to help on the resale price. And I've noticed buyers that bought, out in Texas in 2010, 11, 12, 13, where we had some of these builds that were built like this. They made a lot of money in appreciation, and so again, you will see that theme throughout the Marshall Reddick website on all the multi-units that we sell. So if they're buying as a primary residence, under the best case scenario, it could even be a little bit under a point, depending on their down payment. You could be as much as 3 discount points, depending on their credit scores. And this is what the buyer would pay. So to get pre-approved, to find out and get a loan estimate, the easiest way to do this, if you guys are interested in a property, just talk to Vince or talk to your real estate advisor, tell them which one that you want to look at numbers on. Contact me. You go to reedhauser.com, click on the Apply Now tab, do a loan application, and then this way we can run the credit and we'll set up a loan estimate for you. There's no obligation to do that. It's just this will allow me to get you exact numbers for what it's going to look like to buy that property. When you put more money down, the loan fees are going to be lower. When you put the minimum down payment, the loan fees are going to be a bit higher, but a lot less cash into the deal. Real quick too, when Vince showed the Austin duplexes that are in Buda, I have buyers that I have one that just contracted 25% down. It still does have some positive cash flow. Again, just very, very little, and they wanted to have less money into the deal, and they had really high incomes and didn't really mind having less cash flow. But again, 25% down on the multi-unit, that is an option. The fees are going to be a little bit higher, but again, you could do it with a lot less money into the deal. So if you guys are interested, if you guys want to get pre-approved, you just want to contact real estate advisor Vince, contact me. We'll get you, your application, and then we'll get you guys a loan estimate.
Awesome, Reed. So for those of you that are interested in getting more education, we do have our property rating ebook. This was something that I touched on earlier when it comes to the property classes and how we estimate for maintenance and vacancy. This is just a great read. For those of you that are on, I assume that you're seeking more education, and this is a great another free avenue. You can find this ebook on marshallreddick.com/ebook. It's also in our properties tab. When you're looking at properties, it'll be on your right side on the website where you can click and read through. Happy to send this to you guys too if anybody has trouble finding it. Also, if you enjoyed our presentation tonight, there's plenty of other articles and videos and guides that you can find on our website under the Learn tab. And you would go under Learn and go click on Education. And all of these webinars are recorded. So feel free to review some of the past ones. We focus on various topics, whether it's markets or updates from Reed, from financing, or 1031 exchanges, or self-directed retirement accounts, whatever it may be. There's tons and tons of information that you guys can seek out on our website. And again, happy to help point you in the right direction. Those of you that wanted to grab Reed's contact, here's all of Reed's information here. Again, we work very, very closely with Reed. I'm happy to make any of those intros to make sure that you have that contact and you are able to get his phone number and his email. We, again, wanted to thank Reed so much. We could not be offering these types of rates or these types of programs without Reed and his company. So very, very grateful for him and all the effort he's put in to make this happen. It's been a huge game changer for those of you that are seeking to invest now. And here's my contact as well if anybody would like to schedule a call. I will be doing some follow-up calls tomorrow for those of you that attended, just to get your feedback, see if there was any questions, anything we may have missed. If it's a 1-second call, no problem, or if it's a 45-minute call, whatever you need, happy to help however we can. Very grateful for everyone joining us this evening. I wanted to thank Reed again for all of his time. Really, really excited to be touching base with all of you guys tomorrow and early in next week, and look forward to working with you guys.
Thank you, Vince. Thank you, Marshall Reddick. Thanks all you guys for coming tonight. Really appreciate you guys, and great being on the call. Have a good night.
Have a good evening.